Hello, and good afternoon to everyone that is currently tuned in live with us on another episode of Phillip Trading Podcast. I'm your host for today, and my name is Yongshen. So, with me here today is my colleague Liao, a dealer and marketing executive from Phillip Capital. How are you doing today, Liao?
Oh, I'm fine, thank you.
Okay, so for today's podcast, we will be discussing on the topic the implications of the latest inflation rate. So, to our audiences out there who are currently investing in the US market or the indexes, do not miss out this podcast. And once again, I would like the help of all our beloved audience today to share this video to all your friends. So, the more people that are watching this video, the more we are motivated to deliver greater content to all of you. And without further ado, let's jump into our topic for today, implications of the latest inflation rate. So for US stocks rose on Tuesday after the smaller consumer price increase, buoyed optimism that the Federal Reserve could soon dial back its inflation-taming interest rate hikes. So my first question to you, Liao, what will be your point of view on the US cost of living continues to rise, but inflation appears to finally be slowing?
Okay, so the first thing we need to understand is how do we calculate this, the consumer price index, or we call it a CPI data, and also inflation rate. So the CPI it's an index, so it measures the monthly changes in prices paid by the consumer based on the weighted average prices for a basket of goods and services. And when we base prior year CPI value compared with current year value, we will get the CPI number, which is normally greater than 100. So if the market, current market prices are increasing, then we will get a greater than 100 CPI number. Okay, so when it comes to measuring the inflation rate, we are using the difference between the new and prior year CPI value divided by the prior CPI value times 100, and we will get a percentage which is known as the inflation rate. So we can calculate the annual inflation rate as well as the monthly inflation rate depending if we are using the yearly or the monthly data. Okay, so now when we look at the US inflation rate, we are seeing an increasing rate on a year-on-year basis from the low of below 2% back in 2020 to the peak of 9.1% back in June this year. So, and then since July, we are seeing a flattening inflation rate from 8.5% until the recent 7.1% in November. So the flattening of the inflation rate is actually just telling us that on a year-on-year comparison, we are seeing a slowing inflation. So which means that the prices of going up is slowing down, and it doesn't mean it's going down. Okay, it's still on uptrend, but at a slower pace. So, and if we are looking at the month-on-month inflation comparison, we are still seeing a 0.1% increase as in November as compared to October. So this also means that the price of goods in November are 0.1% more expensive than in October this year. Okay, so this is why although we are seeing a lower inflation rate, but prices are still going up.
Okay, so with the Fed just hike rates again, and may I know, like, may the traders also know that why is it this time is different, and what does it means for the traders?
Okay, so I mean, obviously this time the Fed has only increased the interest rate by 0.5%, which is 25 basis point lower than the previous 4 times, where the Federal Reserve increased the rate by 0.75% continuously for 4 times from May to November. So that means in the space of 6 months, there was a jump of 3% in interest rate. So in total, the Fed has raised a total of 4.25% of interest rate this year from 0.25% to 4.5%. Okay, so with the reducing inflation rate, the market hope that it will clear the way for the Federal Reserve to start scaling back their size of interest rate hikes. However, economists are still expecting the Fed to maintain their monetary policy tightening campaign at least through the first quarter of next year. So the slowing inflation and prospects of smaller rate hikes have raised the hopes that the economy could avoid an anticipated recession next year or just suffer a mild downturn. So as for traders, you may continue to watch out for other economic data, such as the employment rate, CPI, the consumer price index, as well as the PPI, producer price index, to have an idea about whether the job market is still strong enough to make the Federal Reserve more determined to bring down the inflation aggressively. And then whereas for the CPI and PPI, you can take a hint of how good or bad the inflation is being controlled by the Federal Reserve.
Okay, so with the Fed rates being hiked, and then also can you also briefly explain why the performances explain the performance of the interest rate and also how is it will affect the US market?
Okay, so I mean the interest rate will definitely still have room to rise, and the widely expected target is around 5%. So which means that we could see two more round of 25 basis point hike, 0.25%. Okay, to make it to 5% interest rate by next year. So if we look at the historical interest rate movement, we have gone past the high in 2019, and we are still en route to about the 15-year high at around 5%, which we have seen during the 2008 financial crisis. Okay, so the interest rate will have a big impact not only to the US market but also worldwide. But while it usually takes some time for the interest rate to impact the economic, let's say 12 months, but the stock market will be quicker to price in the expectation of rate hikes. So generally speaking, when interest rate rise, the growth stocks would likely to be impacted more severely as businesses are more reluctant for business expansion due to higher debt costs. Therefore, we might see a weaker Nasdaq and Russell indexes moving into next year.
Okay. So from here, like how can traders capitalize and also take a view on in the coming 2023 of the US market?
Okay, so entering 2023, the traders who wish to capitalize on the US market movements next year can enter and trade the US indexes futures. Okay, you can trade in the US indexes futures market because I reckon we shall see a slower momentum in the market when approaching Q2 next year. And in addition, all of the four US indexes should continue their downtrend channels. If you look at the most interest rate sensitive index, the Nasdaq index, we shall see a low risk, high reward setup for the downside because it has more rooms to drop from the current level of 11,000 to the low of 10,700 level, which we have seen in early November. Whereas for the Russell, this is the index with the least strength. And so trader can also look for more downside from this current level now and begin to wait for it to challenge the support of 1,660 level. Okay, so lastly, the US indexes for the traders that would like to have a view in the US market, the US indexes futures are a very good tool for you because you can use it to diversify your portfolio. And also the US indexes futures market run for 23 hours. So which means you can have a very high liquidity market with long trading hours.
Thank you for sharing, and I hope that it will help the new investors out there. And now we have come to an end for today's podcast. If you have any questions or any topics you want us to discuss next week, you can message in the comment box below. So thank you for listening to our podcast and happy trading for the week. And thank you for your time too, Liao.
All right, thank you.